Good afternoon, traders. It is FOMC day. That means the Fed is making a decision on the interest rates. Lot to talk about. And of course, there was someone out there making a bull call. We'll talk a little bit about that. I'll even let you guys see the clip there. Let's get into all the action today. And of course, we got our expert. We got Bob Elliott, CIO of Unlimited Funds and former investment committee member at Bridgewater. Excited to talk to Bob Elliott today. We'll get into all the action in the overall economy, take a look more at the macro, and then talk a little bit about their ETF, HFND. Stick around, team. We got a lot to talk to you about. Stock market movers. Let's get it started. There are 3 ways to make a living in this business. Be first, be smarter, or cheat. I can't help you cheat, but I can give you the informational edge to help you succeed in the markets. Welcome to Stock Market Movers. All the market moving headlines and expert opinions every day. They say money is the oxygen of capitalism, and I want to breathe more than any man alive. All right, team, let's go ahead. Let's take a look at the SPY action. It seems like we're just on a little bit of a leak, but really just hanging in there, right? I mean, right now we cleared back towards 405 yesterday. I've talked about how that 400 level is going to be very vital, right, for the bulls to hold. You guys see my circle above into the 420s. Drew this on the 23rd. If we get up there, oh, you guys will see the old flippage. But for right now, we're still renting names to the upside and, of course, taking swings right now to the downside. But it's been tough. It's been tough. I'll say that. It was able to make a good profit on Tesla this week. But that doesn't mean that all these trades are going to be in the green. Today, having a tough day indeed. Had a green trade on Baba. Had 3 red trades after that. But that's how this market is. Still at least just barely in the red. Let's get into the action. I want to talk about what happened yesterday. So, of course, we've been talking about, is this potentially a bigger move than is being mentioned? Well, wouldn't you know it? Good old Kramer coming in here. We're going to talk about it here. Let me go ahead and get this full screen. I'm going to bring this up here. This is from just yesterday. Let's bring it up.
Second of Mad Money. Follow at Jim Kramer on Twitter.
Faster, stronger, and market that was somewhat pernicious too. It was dominated by
hold on a second. Let me rewind it there.
And I think we are. You have to prepare yourself. Not for days like today where the Dow gained 369 points, S&P jumped 1.46%, and the Nasdaq pulled out 1.67%.
House of pleasure.
But for days like yesterday,
House of pain.
when the averages look like they're rolling over, the bears are screaming about the sky falling, and everybody's bracing themselves for a real
The Bears.
We have to prepare for the down days now because in a bull market, they're buying opportunities.
Buying
How do you get a better
opportunities.
price on the merch or
In a bull
merchandise, as they
market?
say on the trading desk. Problem is, it's hard to think that way when the market looks ugly. We're used to buying the dips and so-called selling the rips. And those
Buying the dips, selling the rips. Kramer coming out saying that the market is in bull mode. So look for opportunities to buy the dip. What do you guys think about that? Is that a topping or is that a catalyst for the market to keep running? We'll talk a little bit about that, but definitely, I mean, Kramer going bull, that just got me a little bit scared. But, I mean, I don't know how you guys feel about that. Let's take a look. What do you guys think? The SPY hasn't done much today. Are these opportunities? Inverse Kramer. We'll have to wait and see. Does that mean sell everything and run? I don't know, right? When Kramer's calling the bull market, it's been tough. But are traders being really too optimistic on a dovish Fed, right? We'll find out a little bit later today. 2 p.m., we get the release. Of course, that's from Fed Chair Jerome Powell, that release that he reads, right? Well, you guys can get that right off of the Fed website, right? I would make sure that I read that before we get to the conference. Conference starts at 2:30. That's really when the fireworks happen. when we get into the Q&A part, at first, it just reads right off of a sheet. I think you guys could read that way before he gets to it, and then look for the Q&A. Pay attention. That's really when we get the stocks to move. We'll find out. 25 basis points seems like the only option. Really, I'm going to be looking more at the Fed Fund futures. What does that show, right? The Fed tool on, of course, the CME Fed Watch. We want to watch that. What is it going to point to in March? Is it still pointing towards a 25 basis points in March? Something to keep in mind. Some people are saying that this is the last rate hike. Some people are thinking that we could still have some more down the line. And of course, this matters more along for the end, the terminal Fed fund rate. What is it going to get to? Will it get to that 5%? All questions to be asked about. And hopefully we get some transparency and truth from the Fed if they're really intending to get it up towards that 5%. And we'll see. Is it a hawkish tune? Is it a dovish tune? What do we get from, of course, the big bad wolf, Jerome Powell? We'll have to wait and see. Of course, let's get back towards the market action. It seems like we've been kind of leaking a little bit all day, but of course, this is all going to change up. We could be pushing higher, right? I mean, if he, for any reason, does get a little dovish, why can't we get through that 410 and back up closer towards that 420? It could very much happen just this week. But we can't forget either. After we get this FOMC meeting, we get the biggest day for earnings, at least on my radar, tomorrow after hours, when we get the big boys to report. That's going to be more important, I think, than even this FOMC meeting, which we can't miss out, right? Google, Apple, Amazon, Ford, Qualcomm. There's so many stocks that are going to perform. But of course, the three big boys there, Google, Apple, and Amazon, all reporting after the close on Thursday. And I think that's very important. That's going to be the day, I think, that determines if we're in a new bull market or not. Because if we can get through those earnings report, not take a hit back, and we can stay up here, well, we keep climbing that wall of worry. What makes me think that we're going to turn around if the big boys are warning to the downside and still able to climb that wall of worry. All right, let's get out of that talk. We'll get into some of the stock action today. You guys smash the like button. It's good to see you guys in the chat. We got Jonathan in the house, MD, Benjamin, Chris, Ipon, Dog Speak. What's going on? Lucky Garcia, how we doing? SPY looks bearish, at least in the intraday. But is that a trick to the downside? And all of a sudden we just stay in the lift. What I'm looking for is necessarily the cut through the 400. Then I can feel like I get more a little bit bearish. But we'll have to see. NVIDIA is making a day, making your day. Well, definitely pushing back up above the inverse head and shoulders. We'll talk a little bit about that. Inverse Kramer has a 90% success rate. Man, I really can't wait till we can just start shorting the Kramer, but we'll keep moving on. That's what I'm all about. That's why I'm Money Mitch. I'm here to replace Kramer, right? That's what I'm here for, team. Hopefully, I can do that for you guys. Let's get to the action. Let's take a look at what is really moving out there. Of course, you guys see AMD still strong, right? Let's talk a little bit about that. This is very important to catch because AMD's report really wasn't the best. But look at the move. Right back up above that 79 today and continued pushing. This just shows us that Intel lowering that bar set AMD up for success. Here you guys see it. Q4 EPS 69 cents beat the 67 cent estimate. Sales at 5.6 billion beat the 5.5 billion estimate. AMD sees Q1 revenue 5 billion to 5.6 billion versus a 5.5 billion estimate. They did say in the PC market, we're planning for a PC total addressable market to be down 10% in 2023. And also looking for overall demand environment to remain mixed with a stronger second half than the first half of the year. We'll see what happens there in AMD. They're trying to set themselves up at least for the second half to have a better year. And you can see it's still got the lift. Earnings came out, it popped and continued higher than that 79. And one thing I think is very important to note is look how Intel even started coming back a little bit today. That is definitely important. If you look into semiconductors, they are getting a nice lift, especially the ones that are like kind of in SoxL and those types of names. You're seeing today AMD get some lift, NPower get some lift, Wolf pushing higher. Look at that NVIDIA trade. We just talked about that yesterday, how it pulled back below the inverse head and shoulders, and was it reclaiming 93? Well, today, 192.50 on the low there for NVIDIA. I'm pretty sure that was in the pre-market. Yeah, it was in the pre-market after hours yesterday on AMD's, and Snapchat's mentioned it was down here to 92.70s, went down there towards 92.50s on one of these cracks, and right back up there towards the 202. Doesn't look bad at all, as NVIDIA's holding the inverse head and shoulder area, now really starting to push back. Big highs coming up is the 27th high, 206.28. We'll see if we get back up there. All right, definitely important to keep your eyes on these semiconductor names as they continue higher. We'll see what happens on a name like Micron. Of course, it has a gap to fill here. I saw this yesterday when it got hit on the NXPI and the Samsung numbers. Was wondering, would it fill the gap? Well, there you go, team. And you guys know I always have my dates here so that I don't look like I'm like kind of cherry picking. If you guys zoomed in there, you could clearly see it was created on the 1st, right? That's when we were looking at this. We were looking at this yesterday and looking to see if we'd fill in that Micron. We talked about it on At the Close. Nice little move back up on Micron. We'll look to see if it comes right back down, though. That's one thing that I'd keep in mind. I'm not the biggest fan of it. I like AMD at least to continue going now that it's starting to push. It could get back up there to 90 even in the next couple of days. We'll see what happens. Next stop for me is going to be up here towards this kind of resistance area, the 85s. But 200 moving average, all the moving averages below, doesn't look too bad there for AMD. All right, let's keep going. Let's get out of AMD talk. You guys saw Snapchat definitely take a big beating. Let's go to Snapchat, see if it's bounced back on the day. Let's go to the 5-minute. You guys can see at the open, we did get a little bit of a bounce in Snapchat, but not much there. I think a lot of this was more based on the guidance moving forward. If the guidance isn't looking good or they're not willing to give guidance, there's a reason why, right? They don't understand the environment right now. They don't know how much they're going to get hit. And with this being said, uncertainties definitely coming in and playing effect in Snapchat. Definitely not a stock that I want to be investing by any means. I don't believe in Snapchat in the long term. I think eventually this becomes a zero, but that's just what I think. You guys make your own investment decision. All right, let's get out of Snapchat. There was another one that took a major beating. Let's go to EA, see if this bounced. And you guys can clearly see no bounce there. If anything, continued downside action. Video gaming not looking good here, team. Q3 EPS $2.80, missed the $3.05 estimate. Sales of $2.34 billion, missed the $2.51 billion estimate. They did state in the earnings, as we navigate the short term, we're focused on building for the long term and remain confident about our future. With amazing talent, proven IP, and growing player network, EA is operating from a position of strength, said the CEO. We'll see what happens there. EA definitely not looking strong today. Daily chart breaking down big. This looks like it's going to continue to slump. I can see this getting through the 110. We'll see what happens. 112s today. Yesterday's low was 113. We're right back towards it today. Let's get to the 15-minute. You guys can see we're right trying to break that kind of after hours action from yesterday of that 113. We'll look to see if we get through it. We're right off of that support. All right, that's going to do it for EA. Let's keep talking. We'll get into some stocks of what was hot and what was not. Then we'll go into some different names. A lot of China EV numbers being released today. Not many people talking about that. I was able to catch a trade on a China name. It wasn't those EVs, but we'll talk a little bit about that coming up. Let's get into what was hot and what was not. Of course, this is where we take a look at the sectors in the industries that were moving. If you guys got a big move or caught something on your radar, throw it up in the chat, and we'll definitely get into it. What's going on out there? How we doing? I do the opposite of Kramer, said somebody. Yeah, we'll see what happened there. MD, where do you see the biggest buyers of chips moving forward? That's interesting to talk about. We can definitely talk about that, MD. Intel, it's way underperformed the semis for no reason. No reason to own it. Yeah, it definitely no reason, I think, to invest in it. But there's some others that are trying to grab it just because it's so beaten down. Hey, it could be a value trap, right? All right, let's get towards the sectors and the industries. Today, you can see, at least from the open, technology and industrials, the only two sectors in the green from the open. So important to catch from the open, right? Overall, you'd be looking just at it, technology. Let's go to technology. There are some names there. Of course, the high cap names doing decent. AMD, NVIDIA kind of pushing higher. Meta still staying into the green. But Apple into the red today, leaked down, just started breaking towards the 142, now bouncing back. Microsoft went into the red, now starting to make its way back. That's a good thing to see as they're starting to get back there. We'll see if Microsoft can get back above the 248s into the 250. And Google, I'm looking for a move back above 100. Today, I got caught on a long on Google, got stopped out, was looking for the move back above the 100. Will we get back there with the FOMC meeting? We'll find out a little bit later today, right? TSM did do a nice little push, pulled back. This one actually looks good, team. I know that I'm worried about TSM in the long term. I'm thinking about just renting it. You can see kind of this support that we're holding around kind of the 91.63s. We filled in this gap already yesterday. Looks like it's trying to hold the 92.05, 92 area. We'll look to see if we get back towards 95 on TSM. Doesn't look too bad. This morning on a spike at 10 a.m. was at 94.89. We'll look to see if it recovers. All right, getting out of TSM and, of course, the semis. Let's take a look at what else is doing good here. Semiconductor equipment's not doing bad right now. ASML, big names there like AMAT. Nice little push up, right? Equipment and materials. AMAT doesn't look too bad. And also has a very similar kind of inverse head and shoulders, really starting to push. Now we're going to look for some highs. They're all up here in the 115s. Can we actually hold up and close above the 115 area? You won't be looking too bad in AMAT. KLAC and LRCX, other ones that are doing well. This one looks a little bit better. You can see here how you're really starting to break through kind of this trend. Now starting to get back above. LRCX, Lam Research, pushing through 500. Looks like a nice support. Could pull back at any point towards the 480s, but doesn't look bad at all. All right, let's keep going. Let's get out of the semiconductor equipment area. Software application names have stayed strong, right? What are some stocks like this? Well, Salesforce, really strong. The RSI is pushing towards 83. Look how Salesforce has really taken off. We're going to look for some other ones to kind of play catch up. Shop had been strong. I'll look to see if it can pull back. But names like Adobe are names that I think could get strong because of that Salesforce getting back there. It's filled the gap. Now holding pullbacks right now around the 363 area. We'll look to see if it takes the next step up, Adobe, and starts to push. Oracle is another one you guys can watch, just kind of similar name. Will that get back through 89 and start pushing through the 90s? Look at the move that Oracle has made since October. This is in its own little bull market. And I think that you need to start looking at certain stocks to see, are they in their own little bull market? And if they are in their own little bull market, what do we mean? 20% from the bottom, right? 20% from the bottom can give you that at least short-term outlook that it's in a bullish move. Another thing you can use is just a 200-day, right? You guys see the 200-day as that purple line. If you're seeing stocks above that purple line, take a look. How far from that purple line you are, right? Is this in its own little bull market? Right now, I think it's definitely more of a stock picking environment. You can't just go into just one industry with all the names. You need to kind of be working in, looking for certain stocks, because right now, even some of the leaders, they're not having the best move. Amazon, let's say even Apple, Google, they're not having the best move right now. It's other names. It's not the leadership that's just driving us higher right now. So with that being said, we need to be really careful in our stock selection. All right, let's get back to the action. I'll catch up what you guys are talking about. INTC 5% dividend. Great 5 years hold. I mean, at the overall, I mean, at least you're getting dividend, right? At least some income. EA bottom may never take out those lows. I could have. I just wouldn't fight EA. I don't think that gaming is an area that I want to be long on right now. I do see gaming kicking up once you see VR and AR really kind of getting adopted. But we talked about that all last year. And did you see the Oculus come out with a killer goggle that everybody wanted this Christmas? No. Wait for that to happen. Wait for Apple's goggles to come out or glasses to come out. When we start seeing massive adoption, when we start seeing the kids not requesting their Xbox or PlayStation console for Christmas, but for the goggles, that's when we need to catch these types of move. And that's when I think you'll start getting that big move in the metaverse or metaverse types of games, and gaming will come back and you will see a lift. We'll have to wait until then. All right, Oracle, another long-term holding, finished building my position, holding for a price at over 100. Doesn't look too bad. Cloud services, I'm with you, EKS. Long-term cloud services definitely makes sense. We'll see what happens there. All right, let's keep going. We'll take a look at some other names. Let's go to the industrial industry or sector, and then let's start taking a look how this has continued. I was watching this for a long time in 2020 and 2021. I actually created this green line here on October 1st, 2021. And I was looking for us to recover this because this was the area that I could see stayed strong. A lot of sectors came down in the bear market. This is not one of them. Let's take a look at some of the names that have been strong and seeing if they're starting to turn around. Caterpillar is starting to turn around. There you guys see it. Just as quick as it was up, starting to come down. Look at Deere. Deere, I talked about, will it hold 420? It's been battling 420. Watch what happens if it does crack that level. Look at the hourly chart, right? Look how this has been climbing its way back. If this cracks, comes down here towards that 410, you could just start letting go and it could crack down. If it holds this, gets back towards 430, could turn around there, right? Picard hanging in there on the pullbacks. We'll see what happens on this one. If those other two let go, this one will actually also look good for a short. We'll have to wait and find out. Of course, we're talking heavy farming and construction, and there's other stocks that have been making a lift in this area, like diversified industrials, right? GE being one of those, right? GE has been making a big lift as of late. Look at the daily chart. This is in its own bull market, right? Industrials have been pushing. GE is about a 25% move. Look at Honeywell. Honeywell's been pulling back. I think this one can go ahead and kind of push back up. It held the 50% retracement, which was slightly below that 200. Went right to the key almost. I have it at 198.97. We went to 198.81. So not too far off the 50% retracement there on the recent move. And that was from October 24th up there towards a high on November 25th, 220s. Will we get Honeywell to come right back up and get through those levels? Something to keep in mind. These are stocks that really have been strong as of late. Airlines, I wanted to see if that was coming back. That's not looking to the best. Trucking having a decent day there. ODFL has been really taking off. Old Dominion Freight Lines. Look at this big push here. What a nice move on the day. Up there towards 364. Got a high of 368.79. I don't trade these often. And if I do, I kind of stick to certain names, but I'd stick to the high cap names here. We'll see if trucking can keep pushing. The industry overall also getting a lift. There's not many red names here. That gives me a little bit of a sign. DSKE getting a little bit of a push, but definitely the drive coming from ODFL, Old Dominion Freight Lines. All right, Captain Kirk, no worries if you got to get out of here. You have a good one, and don't be the knife catcher. Knives hurt. Trust me, they hurt. All right, we'll keep going, team. We'll take a look at some other sectors and industries. In a couple minutes, we'll get into our interview. let's take a look at this financial services. This has been hanging on by a thread for a while, especially like a JPM, right? If we look at JP Morgan Chase, it really came down a little bit off the earnings, but look where it's been since October too. We've been trying to point to certain stocks that are in their own kind of bull market relative. I mean, this is about 37% move since October going higher. And if we are going into recession, wouldn't we see these banks come back down, right? Well, one of the things that I could think of, what would drive this more, was thinking that higher rates, prolonged rates with no recession. That's what I think the banks are at least showing us. And that's something to keep in mind, right? If the banks are going to show us that, should we be trying to trade this trade here? Something to keep in mind. We'll see what happens. I know how Goldman Sachs came back towards that 340s, almost right back towards that earnings. Right before their earnings came out was this Friday the 13th. Then the next day they got hit, right? Well, it could come right back towards those levels. That's why I think Morgan Stanley comes back towards the high. And wouldn't you know it, we drilled this line on the 27th of January, looking for the push there. Morgan Stanley held that kind of pullback for the shadow fill. Didn't want to even come back. Now coming up through the 97.69. Something to keep on watch. Morgan Stanley starting to push again. Not a bad area to be in right now. And I didn't think financial area would be the area that would be doing well. It's not looking too bad. All right, getting out of Morgan Stanley and what was hot and what was not. We'll get into our interview today. Like always, team, there's more to catch on. Peloton making a little bit of leaps. There's so much out there. We didn't get into China EV, so I'll try to leave a little bit of room here at the end of the show to talk a little bit about their numbers and, of course, what happened in Baidu, passive stake there. Let's get to our interview today. You guys smash the like. Let's keep it going. All right, we got Bob Elliott here, CIO of Unlimited Funds and former investment committee member at Bridgewater. Welcome on, Bob. It's good to have you.
Hey, thanks for having me. Really appreciate it. Exciting day. From a macro guy's perspective, doesn't get much more exciting than Fed Day.
Definitely, it doesn't get more exciting than Fed Day. Of course, the fireworks will probably be at the conference. Excited to read the press release at 2 p.m. That's going to be good. But of course, one of the things that I feel like everyone's been talking about, some people talk about it as it's already come. Some people talk about it that it's coming. And some people talk about it that it's never come and it's never coming. Of course, the big word, recession. What do you think you're seeing out there?
Well, certainly the recession has not happened. Unemployment is at secular lows. Growth, at least through the fourth quarter, was running at 2 or 3%. Even, some of taking into consideration some of the more volatile components was still running at a couple of percent. And PCE through the quarter was running at a couple of percent. And so all of that, pretty much nothing that the Enber or anyone else would look at to identify a recession has come into the recessionary territory. We're not at that point yet. I think the main question is we're probably in a transition point, and part of the question and one of the challenges is this a transition point that will transition us to a recession, or are we seeing mostly just kind of a bit of a growth hiccup in November, December, early January? Some of it is weather related, actually. It's like a non-trivial impact of what's going on. Like we saw in the ADP report this morning, some of it is probably real. But when you have the sort of, continued okay wage growth, good employment, you have a reasonable amount of nominal demand. Oil prices have fallen a lot from where they were before, even though they've ticked up a tad. The odds that we're going to quickly go into recession are pretty low. The odds that we get to a recession later in the year, those odds are starting to rise for sure.
I saw in a recent blog that you guys put out, and definitely you guys keep up with Unlimited Funds blogs. They were really interesting to read, and I lot of great graphics there too. So definitely want to give you the shout out there, Bob. I actually have some we'll probably bring on. But also in that blog was mentioned the perfect picture of Goldilocks. What does that mean?
Yeah. I mean, I that blog post describes that what it looks like is we're in a transitory Goldilocks environment, which is that growth and employment are okay. I mean, employment's pretty strong in the scheme of things with the unemployment rate where it is, and growth is moderating, but still enough to keep the economy going okay for a while. But what we've seen is a slowdown in inflation that's very important, and particularly from the Fed's perspective, right? They're very focused on inflation. They sort of have taken for granted that the economy is strong enough, so that's not their primary focus. They're very focused on inflation. And when you see that, what you see is that a lot of the inflationary impulses that we saw back in 2022, which got the Fed started, those have started to moderate. And we've actually seen PCE, core PCE and headline PCE, which are the Fed's preferred measures of inflation that they're looking at, those have been very low. In the headline number has actually been negative for a couple of months. The core number has been basically at the Fed's target. And so what they're really wrestling with is, will that persist? Can we continue to get low inflation and decent growth in a strong employment environment and have that continue? The reason why that combination of things, good growth, good employment, low inflation, is Goldilocks. It's exactly what the Fed wants to see. It gives them the space to slow down their pace of tightening. But the question is whether that can persist. It is very unusual for Goldilocks periods to persist, particularly this cycle. Either what happens is there hasn't been enough tightening, and so the economy reaccelerates. My bet would be a bit on that side, at least for the time being. Or the Fed has tightened too much, and the economy starts to have that sort of self-reinforcing cycle. And so you don't get Goldilocks for long. Goldilocks is a transitory concept that will probably not play out for the rest of the year. It'll probably play out on the order of months.
So it seems like, and I had this question a little later, but I'll bring it up here. I think it's an important one, is the soft landing narrative, right? It seems like almost like the soft landing narrative could be in that Goldilocks scenario, but then
for sure,
out of that soft landing. Is that what you could possibly see, Bob?
Yeah, I think that's soft landing. Some people call it soft landing. Some people call it Goldilocks. I think the probability, when you look at what's going on right now, if you went back 6 months ago, you'd say the odds that we get a soft landing are very low.
Yeah.
The reality is we've gotten a softer landing than I think most people expected. Certainly most economists expected, and even the Fed expected. And so that's raised the probability of, that we get a longer term or more durable soft landing for maybe 5% to 20%. The problem is when you look at asset markets, to the extent that stocks keep going up and bonds keep going up, meaning bond yields keep falling, what you're actually seeing is people are pricing in more and more of that Goldilocks to be the most likely outcome. That Goldilocks or that soft landing to be the most likely outcome. And so right now we kind of have this disconnect, which is where it's like Goldilocks has increased in probability, or soft landing has increased in probability, but it's nowhere near what the markets are pricing in. So the markets are pricing in cross assets right now, like an 80% probability of a soft landing, when the macroeconomic reality is probably closer to a 20 or 25% probability. And so that's where you have to be careful. I think it's particularly mispriced in bonds, a bit less so in stocks, and a bit less so in certain stocks. So it's not well priced in like U.S. mega cap stocks, the top 10 or 20 stocks in the U.S.
Definitely.
But there's a lot of equities where I'd say it's reasonably priced or close to reasonably priced. And so it's really the bond market that I think is not getting the picture that the odds of Goldilocks seem very low.
With that mention of the bonds, of course, as investors, we need to start thinking about portfolios, right? And how we construct them, right? For so long was the classic, right? The 60-40 portfolios.
Exactly.
What should investors be thinking about now? Is it looking at growth? Is it 100% equities? What do we look at, Bob?
Well, I think there's two key things to think about that would complement sort of a traditional 60-40 type allocation. One is the pricing of commodities right now still remains relatively low. If you look at oil prices are back to pre-Russia invasion of Ukraine levels. That's interesting. That's an interesting perspective. If you look at break-even inflation, that is priced at 2%, basically a return to the sort of normal level that we've seen over the course of the last 20 or 30 years. And so you look at the pricing of inflation, and what I'd say is that's priced pretty cheaply, particularly commodities, gold, oil. You can buy a diversified basket of commodities with like the BCI ETF, something like that, where those are priced quite reasonably and would be a nice set of protection for a traditional 60-40 portfolio, which, as we saw last year, doesn't do that well if inflation comes in above what people expect. The other thing I'd say is, I know it's not sexy, but cash. Cash is not a terrible asset. And people, I think, often discount the value of cash because cash, particularly today, is yielding. It's one of the highest yielding assets that's out there, right, on the short end, giving you 4.5% or 5% in that ballpark. But then also what people often misjudge or misvalue is that cash has option value, right? The fact that you have cash gives you the opportunity to deploy capital to underpriced assets down the line. And that option value in an environment of macroeconomic tightening is actually really valuable for the investor. And so there's I know it can sound, at a cocktail party, you don't say, well, you know what I've really got great right now? I'm holding some excellent T-bills yielding 4.5%, 5%, right? That will not make for good cocktail party conversation, but it does make for prudent asset management.
Yes, and I mean, in a day and environment where the uncertainties are, if anything, growing, absolute returns doesn't sound too bad, right? I mean,
certainly
that's
relative to the risk, right? You don't have to stress. You get your T-bill return no matter what.
I think it's definitely an important outlook. There wasn't an alternative for so long. And I mean, I still think about the days where they were like, oh, yeah, do you want to get this savings account? We'll give you a lovely less than 1% return.
That's exactly right. That's exactly right. Today, it's, 5%. And that's, if you go back to previous cycles, whether, if you were in 2008 or back in 2000, if you had taken the 5% and run, you'd surely be happy and a lot less stressed than what many other investors suffered through the time.
Yeah, I mean, a lot of people look at the market as a way to generate wealth and all that, but there comes some uncertainty with that, right? And I think that a lot of people might have to adjust there. And I mean, 5% isn't the biggest return, but when it can be something that can bring that uncertainty down where you could sleep good, I think if anything, it just leaves options for diversification where you also don't think as investors where we have to just pile all our extra cash into the market, right? There's other ways to now I'll put a little bit into the T-bills. I'll put a little bit here, a little bit there. It doesn't all have to come right back towards the stock market, especially in a prolonged interest rate environment. So I think we're all looking at these opportunities here. And it's going to be fun because I think that there's been a long times where bonds weren't sexy, right? I mean, who knows? Bonds is going to start being a talk that is going to be something that we'll all focus on, right? We all look at the bonds probably bottoming first, and we've seen how the bonds have started to react. That gave us a little bit of a sign that the market's turning. We'll just have to see if this is really kind of the new bull market, right? Now, one of the things that I think you guys are talking about in a recent blog that is also very interesting is the recent increase in trend following strategies. Talk to us a little bit about this, Bob.
Well, trend following strategies have been a pretty well-known, let's call it alternative investment strategy for a long time. Often, trend markets from a macro guy's perspective, you could think about markets as basically a little bit like a rubber band, which is they kind of move out and then they snap back. And particularly when you get markets that snap back, you get reasonably defined trends on a short-term basis, and trend following often does very well in those environments. And so you get the performance of trend following is typically sharp outperformance and then chop, and then sharp outperformance and chop. And that's kind of how that looks through time, particularly if you hold it on a diversified basis. And so that's basically what we saw last year. Was we saw a big shift in, the inflation pressures built up. You've had a big trend reversal, a big move from equities and equities going up to equities starting to go down, and from bonds from basically chopping to starting to go down meaningfully. Trend following strategies outperform very well. The challenge of trend following strategies, and this is the challenge of any return chasing investment strategy, is that if you buy the strategy right after it is done very well, it's like buying the flood insurance after the hurricanes come through. Like, it's really expensive, right? And typically trend following strategies you see actually underperform diversified alpha strategies in the 12, 18, 24 months after it's done really well. And a lot of investors saw trend following strategies do well, whether it's mutual funds or a number of different ETFs that are out there, piled into them. And then those strategies haven't done very well over the last 4 or 5 months, and actually they've lost more money than they made. The average investor in trend following ETFs has actually lost meaningfully more money than money that was made in those strategies, because so many people piled in afterwards. So it's a good example of a buyer beware circumstance where you need to be careful about going out and buying the strategy that has done particularly well over the recent period, and particularly with trend following strategy.
Yeah, definitely. I mean, maybe not in the ETF case and all of it, but I mean, this January effect, it certainly seemed like the trend following strategies were out there, and a lot of people buying off of the dips. Now let's see if they sell the rip and get those profits or not, right?
I mean, a lot of them got burned by the up in October, November, the down in December, and the up in January. That's a very, from a trend following strategy perspective, that's a very choppy market.
Yes.
It's very hard to trade. And so they're getting whipsawed all around. And it's a good example of how hard, you don't want to rely on trend following as certainly your only strategy that you're going to put on as you're going through, times like this with elevated uncertainty, because you'd expect a lot of chop through a market of elevated uncertainty.
Definitely. Now, the last thing I want to do is just leave us a little bit about HFN, the FHND, right? The unlimited HFND multi-strategy return tracker ETF. Tell us a little bit about that before you get out of here.
Yeah, for sure. The HFND ETF, my career is obviously a long time in the hedge fund space. We had this idea of bringing low-cost, diversified index returns from that replicate the returns of hedge fund strategies and make them available to everyone. Typically, hedge fund strategies are only available, to the most sophisticated investors out there in the world. And we developed a technology based upon our experience that allows us to sort of look over the shoulder of the managers, see what they're doing in close to real time, take that understanding, translate it into long and short positions in low-cost index ETFs, and use that to back our ETF. And that's what you see here. That's what we're doing. It's the sort of strategy, diversified hedge fund strategies are the sort of strategies that over a long period of time typically do better, a bit better than the stock market, but with also lower volatility and smaller drawdowns. And that's what we wanted to make available to everyone.
Definitely going to have to bring you on a little bit more to probably expand on that, but appreciate you coming on today, Bob. We'll definitely have you back on, and have a great day.
Great. Thanks so much for having me. Really appreciate it.
Take care. All right. There you guys see it. I enjoyed that conversation with Bob. I could have kept talking with him all day, but the first thing I see on the PDF release, press release is out there, team. I am seeing the stocks move around. And what does the headline read? Federal Open Market Committee reaffirms its statement on longer run goals and monetary policy strategy. I gave you guys the link directly to the PDF where you guys can read before the conference. This is what I'm trying to teach today. Read this before the conference, so that by the time you guys see Jerome Powell reading off of this, you guys already understand this and are ready for the Q&A action. That's where the fireworks come. Smash the like button for that kind of knowledge there. And let's take a little peek into the market. I know it's already 2 o'clock. I'm running overtime. AB did it, right? I can go a little overtime too. We'll take a look. Smash the like button. Guys, the SPY is moving all over. First reaction was down there towards 402.50. I talked about my levels important to watch. Above, let's say, the 406, you got green above. 400s on the downside. That's the only area that I'll start getting a little bit more concerned for the bulls out there. We'll see if we're able to hang on, team. Hang on. Release is out. 2:30 will be the press conference. Don't go anywhere, team. I'm going to actually redirect you directly to that press conference stream that we have so that you guys can watch all the action that's coming up. You don't want to miss it. Of course, that's when the fireworks start. This will actually bring you over to that. So you guys don't got to go anywhere. Stick around, team. We got a lot for you guys. And I will be in the chat trying to talk about what I'm seeing and reading through this press release. I need to go read it before Jerome Powell comes on so that I can give you guys, of course, the value on at the close a little bit later today, 3:30 Eastern. Don't miss it. And if for any reason the FOMC meeting ends a little bit early, I will try to start at the close early. I want to be there. I want you guys to be there. Smash the like button. We'll see what happens today. Will the big bad wolf, Jerome Powell, bring this market down? You guys smash the like button. Now bringing you guys over to that conference stream. Stick right there so that you guys can see it the moment it starts. 2:30. Maybe talk about the markets right now. I'm going to go read this right now, and I'll give you guys some insight in the chat. I just need to go ahead and get to it. You guys smash the like button right here on Benzinga.